Ever wondered how the stock market actually works? You hear about it every day? Stocks rising, markets crashing, billionaires being made overnight? But what really happens behind those tickers and trading apps? In this video, we'll break down the stock market from the ground up, what it is, how it functions, why people invest in it, and most importantly, how you as a beginner can understand it without getting overwhelmed. So, grab your notebook because by the end of this video, you'll know the stock market basics like a pro. What is the stock market? Let's start simple. The stock market is a marketplace where people buy and sell ownership in companies. That ownership is called a share or a stock. Imagine you and your friends want to start a pizza shop, but you don't have enough money. So, you divide your pizza shop into 100 shares and sell them to investors. Now, anyone who buys those shares owns a small part of your business. That's essentially how companies raise money in the real world. They sell shares through the stock market to get capital for expansion, research, or new projects. And in return, investors hope the company grows, because if it does, the value of their shares increases too. Why does the stock market exist? The stock market exists for two main reasons. One, for companies. It's a way to raise money without taking on loans. Instead of paying interest, they share ownership. Two, for investors, it is a way to grow wealth by participating in a company's success. This system fuels innovation. Tech giants like Apple, Tesla, or Amazon became household names partly because they raised money through the stock market. How does trading work? Okay, but how do people actually buy and sell stocks? Traditionally, companies list their shares on an exchange, like the New York Stock Exchange, NYSE, or NASDAQ in the US, or the ASX in Australia. Think of it like Amazon, but instead of buying clothes or gadgets, you're buying stocks. Now, back in the day, traders yelled orders on a trading floor. Today, most of it happens digitally in seconds. Here's the process. You place an order through a broker, apps like Robinhood, Fidelity, or ComSec. Your order goes to the stock exchange. A seller matches your buy order at an agreed price. Boom, you own a stock. Prices move based on supply and demand. If more people want to buy, the price goes up. If more want to sell, the price goes down. Types of stocks. Not all stocks are the same. Broadly, there are two main types. One, common stocks, the most popular. You own a slice of the company, and you might get dividends, cash payouts from profits. You also get voting rights in shareholder meetings. Two, preferred stocks, less common for beginners. They usually pay fixed dividends but don't offer voting rights. But investors often talk about stocks in categories. Blue chip stocks, big, stable companies like Microsoft or Coca-Cola. Growth stocks, fast-growing companies like Tesla or startups. Dividend stocks, companies that regularly share profits with investors. Each type has its own risk-reward balance. How do investors make money? There are two main ways investors earn from stocks. 1. Capital gains. When you buy a stock at $50 and later sell it at $100, that profit is a capital gain. 2. Dividends. Some companies pay shareholders part of their profits, usually quarterly. But here's the catch. Stocks can also lose value. If you bought at $100 and it drops to $50, you're down 50%. That's why investing is about strategy and patience, not guessing tomorrow's price. Major stock market players. The market isn't just you and me trading on apps, it's a whole ecosystem. Retail investors, regular people like us. Institutional investors, big players like pension funds, hedge funds, and banks. Market makers, firms that ensure there's always a buyer and a seller, keeping trades smooth. Knowing this helps you understand why markets sometimes move in ways that don't make sense. Big institutions can move billions at once. Risks of the stock market. Now let's be real. The stock market isn't a money machine. It has risks. Volatility, prices can swing wildly. Market crashes, economic downturns can wipe out years of gains. Company risk, not every business succeeds. But here's the secret. Historically, despite short-term crashes, the stock market has always trended upward long-term. That's why seasoned investors preach, time in the market beats timing the market. How to start as a beginner. If you're a beginner, here's how you can get started safely. 1. Educate yourself. Understand the basics before investing real money. 2. Open a brokerage account. Choose a beginner-friendly platform. 3. Start small. Invest only what you can afford to lose. 4. Diversify. Don't put all your money in one stock. Use ETFs or index funds to spread risk. 5. Think long-term. Avoid chasing quick wins. Focus on steady growth. Remember, the market rewards patience, not panic. So let's recap. The stock market is a place where companies raise money and investors build wealth. Stocks represent ownership, and prices move with supply and demand. You can make money through capital gains and dividends, but risks always exist. The secret to success? Start small, diversify, and think long-term. The stock market may seem intimidating, but once you understand the basics, it's one of the most powerful tools to build financial freedom. If you found this video helpful, hit that like button and subscribe for more finance education. In our next video, we'll explore the differences between mutual funds, ETFs, and hedge funds, and which one might be best for you. Thanks for watching, and remember, investing isn't about quick wins. It's about building wealth for the future.